Welcome, everyone. We're delighted that you've joined us this afternoon to talk about the impact of our recent Tax Cuts and Jobs Act and what impact that has on choice of taxable entity. So those of you who are having trouble with sound, Morgan, if you'll put a note in the chat pod box for people to check that mute button at the top of the screen. And make sure that that is off if they're listening through the computer. Okay, well, we want to get started. This is the fifth in our series of webinars about the new tax law, and we wanted to get to this point where we could sort of summarize together and think about how all of these different ingredients and provisions are working together and against one another. My co-presenters today, Barry Wines, who is both a CPA and attorney, Michael Elliott, who's a CPA, and myself. Barry spends much of his time dealing with private equity funds and acquisitions and dispositions and C corporations. Michael specializes in partnerships and pass-through entities, and I am the catch-all to answer and keep up with other things. So with that, let us move forward past the basic information. But the Tax Cuts and Jobs Act has some far-reaching implications. It really impacts how we decide how to capitalize projects, whether with debt or equity. Those make different choices today, and Michael is going to talk about the interest expense limitations, the complexity of that, and how it weighs on different types of entities. Choice of entity, that's what we're all about here today, about how quickly an investment or project can be deducted and what limitations there may be on those deductions, the ability to deduct losses that are actually generated, and frankly, how are the states going to respond to all this, and what is the impact of that? Next week, our state and local tax team will be talking about that in particular, as the states have had a bit of a time to digest this and think about where they may be going next. Today, we're going to start with a bit of background about the traditional approach to making a decision about what sort of federal taxable entity to use, a C corporation, a pass-through entity like an S corporation or a partnership. That's going to be impacted by the interest expense limitations and by the pass-through income, Section 199A deduction. Those are really two very important provisions that are, besides the change in tax rates, that are impacting decision about what to operate in. It also brings up Section 1202 stock and that exclusion from taxation of gain on the sale of corporate stock. And that is now coming into play when people start talking about exit strategies and which form of entity they should be in. There's a lot of particular rules about that, and so Barry is going to walk through that, as well as many of the other entity choices that are many of the other considerations that come into play when we start talking about what entity to choose once we get past the tax rate discussion. And finally, we're going to close with how we're thinking about these analysis and what we think is very important between now and March 15th for you to be thinking about. So with that, Barry, give us a little background on how we traditionally make this decision.
Good afternoon. Thank you, Sarah. So traditionally, when we had entity choices, the first decision point was generally, do I want to be a pass-through entity or do I want to be a C Corp? Most of the small, closely held businesses chose C Corps only when there's necessary, because the primary driver of that was, a double level of taxation. The corporation would be taxed at the income when earned, and then the shareholders would be taxed again when that income was distributed in the form of dividends. So generally, pass-throughs were more favorable because there's only one level of taxation. Once you got to that decision point, the second decision point was, should I be an S Corp or should I be a partnership? And some of the factors that come into play there is how you deal with compensation to owners, some of the benefits. Economics of the deal were a big driver. Do I have special allocations? How I'm dealing with this, which can be done in a partnership, more pro rata in an S Corp. Eligible owners, do I have owners that are not eligible for an S Corp? Liabilities, basically, am I going to fund this with debt? Are there going to be losses? Things along those lines. And again, flexible versus pro-rata distributions among the owners are some of the traditional things that we looked at. So obviously with the Tax Reform Act, there were major changes to a C Corp. So now there's a flat rate of 21%. There's no difference between personal service corps and regular corporations because there's only one flat rate. AMT was eliminated. And for NOLs incurred after December 31, 2017, there is no longer a carryback. So those can only be carried forward. Instead of having a 20-year limit, those are now unlimited. The downside to that is in the year that you go to use that NOL, it can only offset 80% of your taxable income. So it will not be a complete wipeout of the income like NOLs prior to 2017 were. In the individual side, we had some other changes. So now the new top tax rate is 37%. It starts at married filing joint at $600,000, $500,000 for singles. We've got a Section 199 Cap A pass-through deduction, which is a deduction of 20% of certain qualified type pass-through entity income. The impact of that is it lowers the top rate from 37 down to 29.6 on some of that income. Now previously our top individual rate was 39.6 and started at 470,000. So even on the rate change itself, it dropped the percentage points and it increased the threshold at where that number started. So why are we talking about entity change? So here's a quick example. So if you have a business that distributes all of its income annually to the owners, and we're not factoring in state income taxes or self-employment tax for a moment, if I'm a pass-through and I'm eligible for the 199 Cap A deduction, then my effective rate, top effective rate is 29.6. If I'm a C Corp, by the time the corporation pays tax on it and the individual pays tax on it as a dividend, it's potentially up to 39.8%. If there's no deduction under 199 Cap A, then my pass-through rate is 37% and my C Corp dividend is 39.8. Those you can see are a lot closer. Maybe it makes sense for other reasons. But the key here is in a situation where you do not distribute all the income annually. If the income is being retained, now my corporation rate is only 21% because I haven't yet paid dividends out, and therefore those tax rates are much lower than the pass-through rates. Now, don't forget I need to get that cash out of the business at some point in the future, and potentially I'll pay a higher rate at that point. So some of the other changes is C Corps can now use cash method at much higher levels, where those rules before were only $5 million. Now they're up to $25 million. There is a new rule about self-created patents and other type self-created intangible assets. One of the things that, because of that, it's going to be taxed at ordinary income rates, and those would be maybe more favorable inside a C Corp. And the repeal of the 199 deduction also has taken place. So some of the important planning points to note are that there's a difference in the deductibility of state taxes now. Corporations can still deduct their state taxes without any limitations. Individuals no longer can deduct state taxes except up to $10,000, but that includes real estate taxes. And the critical point that we need to keep in mind throughout all of this, and when talking about C Corps, is C Corp earnings are generally subject to two levels of tax. Once, when the C Corporation earns it, it's subject to federal and state tax. Second, when it distributes those after-tax dollars to its shareholders, the state and federal will generally tax that again. So again, that's a critical piece to think about as we move forward. So Obviously, tax reform before was kind of a straight line, and now it's all over the place. So we'll move on now to the interest expense limitations, and Mike will take it from there. Mike?
Oh, sorry. One of the things we're going to get into here is the limitations on business interest expense deductions. Sorry about that. I guess you guys couldn't hear me, but thanks, Barry. The interest expense, previously there was no limit really on the deduction of interest expense except for this earnings strippings rule, which some of you may be familiar with. That just applied in some limited scenarios for some C Corps. But tax reform actually repealed and replaced that with this new limitation on the deductibility of business interest expense. And this now applies to all taxpayers regardless of what type of entity you use. Generally, net business interest expense is only deductible to the extent that it doesn't exceed 30% of your EBITDA, and that's through the year 2021. And then they changed the rule again in 2022, and then you're limited to 30% of EBIT, which is really after depreciation and amortization. So to the extent that you have interest expense that exceeds 30% of your EBITDA, you can't deduct it. You have to carry it forward, but it's carried forward indefinitely. So anyway, the next thing I wanted to talk about, just getting into a little more detail, is how this limit actually applies. And there is an exception. There's actually a couple of exceptions. If you're like an auto dealer and if you have floor plan financing, there's no limit on the deduction for that. So that's exempt from the 30% limit, so you don't even consider it. And then also, real estate and farm businesses can make a one-time irrevocable election out of these rules. But then you have to use ADS, which is you have to use a slower depreciation method, and you would lose bonus depreciation on any kind of 15-year property or leasehold improvements that you had. And otherwise, it just slows you down a little bit. That could be a much better option rather than losing your interest expense deductions. And then there's the small business exception, which I'll get into next. So the small business exception, they define it now as if your average gross receipts for the last 3 years are under $25 million, then you are considered a small business taxpayer. These rules don't apply for you. But these rules can be extraordinarily complex when you have members of an affiliated group and parent and sub-relationships and brother-sister companies. Generally, you have to aggregate the gross receipts for all your related and affiliated entities for purposes of this $25 million gross receipts test. So you can't just go form a whole bunch of entities to split your gross receipts up in order to avoid these limitations. And what that also means is that the limits may apply some years and not others. So maybe this year you're a small business taxpayer, you can deduct interest expense without exception. Next year you may be over, and it's an annual test to see if these rules apply to you. I think it might help to get into an example here. So the first example that we have here is how it would apply in 2018. Only net business interest expense, which is basically your interest income less your business interest expense, is subject to the 30% limit. So to the extent you have interest income, there's no limit. But to the extent your expense exceeds your interest income, then you're subject to this 30% of EBITDA limit. So in this case, we actually have $1,498,000 of net business interest expense because we got $1,005,000 of interest expense and $2,000 of interest income. So our limit is 30% of our EBITDA here. So we have EBITDA of $3.3 million. We're limited to 30% of EBITDA, so we can only deduct $990,000. Then we also have to carry over $508,000 to the next year. And then the second example, which I'll show you now, actually is the same facts in 2022. In that year, then you have to reduce your EBITDA further by your depreciation. So it would go down to $2.3 million. So the max net interest expense deductible that year would be 30% of your EBIT, which is $690,000. You can only deduct $690, and you'd have to carry forward $808 to 2024. There's some computational rules, and again, regardless of entity selection, the business interest expense limitation always gets computed at the business entity level first. So to the extent that the entity can deduct its business interest expense, it does so. There's also a double counting rule which applies in the case of pass-through entities. The owners actually can't count their share of the EBITDA from the pass-through entity to the extent that the pass-through entity already used it to deduct interest expense. So if you have a disallowed portion at the entity level, it gets carried over to the entity's next taxable year in the case of corps and in the case of C corps and S corps. And one of the differences in treatment is that in the case of partnerships, the disallowed portion actually gets passed through to the partners, and then the partners have to then carry it over at the partner level to the next taxable year. So that's a difference. S corps and C corps get treated the same. It gets suspended at the entity level. In the partnership setting, it actually passes through to the owners. Okay, so this is double counting rule again. I'll explain that one more time. Adjusted taxable income can only be counted once for purposes of providing the 30% benefit. And therefore, at a pass-through entity, this limit applies first at the pass-through entity level. If your interest expense exceeds 30% of the pass-through entity's EBITDA, the pass-through entity has fully utilized the limit, and therefore none of the pass-through income on the K-1 can be counted in the owner's adjusted taxable income calculation. And I can illustrate this best with an example here. So this double counting rule is that, so if you have a partnership that has $1 million of adjusted taxable income and 50% owners and $400,000 of interest expense, it can only deduct $300,000. So each partner would get 50% of $700,000 of ordinary income on their K-1. So if they have any additional interest expense at their own level, they can't count any of their $350,000 share in their own EBITDA calculation for purposes of deducting their own interest expense, because the partnership already fully utilized that income. If you have a disallowed interest expense carry forward, again, there's a difference based on the entity type. If you have an S corp or C corp, it's carried over at the entity level, and it's treated as paid or accrued by the corporation in the next taxable year. And if you have any disallowed interest expense, it's considered a tax attribute of the corporation. And that could be subject to limitation under Section 382 if you have a sale in a future year. So the corp may or may not get to utilize that interest expense in the future. But in partnerships, it's different. What I want to get into there is that, so if we have this, if we had an S corp, and if there's any disallowed interest expense, it doesn't pass through to the shareholders, but it's carried over and stays at the S corp level. But the disallowed interest expense also doesn't reduce the shareholders' basis in their stock. But in a partnership, the disallowed interest expense actually passes through, and it reduces the basis of their partnership interest. The owners then have to carry forward the disallowed deduction to the next taxable year. To the extent that the same partnership doesn't fully utilize its own limit in future years, and if it generates some excess taxable income later from the partnership, then their share of excess taxable income can be used to absorb anything that was previously disallowed that was passed through from the same partnership. And once it's fully deducted its own suspended interest expense, if there's any remaining excess taxable income, then they can use that to deduct any other non-pass-through business interest expense that they have. Here's the thing, if they don't ever get to utilize that interest expense by deducting it, but they later sell their partnership interest, if there's any suspended business interest expense remaining, they can then add that back to their basis to offset their gain or loss. So one way or another, they will get a benefit for it in the partnership setting. Now, if we have this excess taxable income, I want to just illustrate that with an example. If there's any unused limit on a pass-through entity's EBITDA, it actually passes through to the owners and it provides a benefit without violating the double counting rule that I mentioned. It's called excess taxable income. So each pass-through owner gets to include their share in their own EBITDA for purposes of deducting any other interest expense that they have. This doesn't apply to C corps, though, obviously, because it's not a pass-through entity. So in my example here, just wanted to run through the same facts as previously. Have $1 million of adjusted taxable income and 50% owners, but $200,000 of interest expense. In the previous example, it was $400,000. So in this case, they could have deducted up to $300,000, so they're under their limit. So they've actually used 2/3 of their adjusted taxable income to deduct interest expense. So the 1/3 of their adjusted taxable income that they didn't use is considered excess taxable income. So they have about $333,000 that the partners can utilize without violating the rules. So they could just split it up. Each partner gets $167,000 of excess taxable income from the partnership. They can add that to their own adjusted taxable income from other sources, and then they can use that to deduct their own interest expense. So in other words, this gives them the ability to each deduct another $50,000 each of non-pass-through business interest expense. Because, again, the partnership utilized $200,000 of the $300,000 limit. Each partner gets to use $50,000 a piece, so $100,000 in total of the same adjusted taxable income. So with that, I'm actually going to turn it over to Sarah, and thank you very much.
Right. So as Mike discussed, when you start looking at tiered associations or tiered entities or mixed groups between partnerships and C corporations, or partnerships that own C corporations, or C corporations that own partnerships, there are some complicated rules about when and how an individual gets that interest expense deduction. The IRS, I think, Mike, correct me, but I believe just recently sent out some, made some comments that they are thinking that the interest expense limitation calculation should be done at a consolidated group level among C corporations rather than on an individual C corp, but they have not officially provided any rules on that yet. So that is critical to thinking about the structure and organization of a company and how much deductions may be lost. The other key piece is how this new pass-through business deduction, Section 199A, fits in. You guys may have heard this presentation in some of our earlier webinars. We keep talking about it because it's a complicated idea and something brand new, and we need to sort of build it into our talk and understanding of how pass-through entities now work in order to take advantage of it. But as Barry mentioned earlier, this is basically a non-cash deduction that will reduce the individual income tax rate on that qualifying income from 100% taxable to 80% taxable. So if someone is in the maximum tax rate of 37%, it can reduce the tax rate on that income to 29.6%. As we mentioned, there are some what are referred to as guardrails around this to prevent the wrong sort, as they like to call it, from taking this deduction. So once your income gets up to a certain level, the expectation is that if it is a service type income, it will no longer qualify for this deduction. If there is not sufficient wages or tangible property to the business, then there would not be eligible for this deduction either, or there would be those limits to reduce the amount that would be eligible. Specifically excluded are specified service trade or businesses. This would be the health, law, consulting, athletics, etc. Those where the reputation or skill of the owner or employee is critical to this. Earlier in the presentation, we talked about personal service corporations, C corporations now having a 21% tax rate. So for a large service organization, law firms, other engineering, well, not engineering, they're exempt from exclusion here, but certain other large consulting firms that may be operating in a C Corp setting and were considered personal service corporations paying the highest tax rates, now they would be paying at a 21% tax on any income left in the C corporation. If that income was passed out, depending upon the level of owners and their taxable income, they may not be eligible for this deduction and could be looking at paying at the highest 37% tax rate on that income. I've got an example in a minute that I will show you, but just so we understand how the taxable income applies, for those that have less taxable income than the $157,500 for single taxpayers or $315,000 for married filing jointly taxpayers, there are no limits or deduction limitations as to or exclusions that have to be taken into account in calculating this deduction. For those that are over $207,500 for single taxpayers or $415,000, then the limits and exclusions, the wage limits and exclusions are fully apply. And in between is the phase-out range, where both these rules on excluding the kind of income and the W-2 wage limitations do apply. So a couple of key points before we look at the example. The deduction is really determined by the shareholders and partners on their individual tax returns. You're going to need to give those individuals, owners, information from the entity itself so they can make these calculations, such as what is the tangible property cost and what is the W-2 wages paid during the year, what is their share. This deduction is available to trusts and estates. Thank goodness that they were included in here. The deduction is from taxable income. It is not a page 1 of Form 1040 adjustment to adjusted gross income. It is not an itemized deduction. It falls really, if you were thinking about your Form 1040, it falls on the second page after all of those other deductions. It's not subject to AMT adjustments, which is helpful. And it only applies to income tax, this deduction. So self-employment tax is not going to be reduced by this deduction for those that are eligible. And any negative amounts are carried over to the next year. So in our example here, we have a husband and wife. The husband is involved in a partnership. The wife has a Schedule C consulting business, and together they own some real estate, rental real estate activities. So what might this look like? Well, their taxable income is $650,000, so they're fully into all of the limitations and exclusions. So in the very first, when we look at the husband's partnership income, he is subject to the W-2 wage limitations, and therefore, even though the income itself would make him eligible for a $50,000 deduction, the W-2 wage limitations haircut that, and he's only going to get $40,000 out of there. And as for the wife's consulting business, because that is a specified service trader business and they're over the income threshold, she gets absolutely no deduction for that whatsoever. So no Section 199A deduction for her income. And then finally, when we look at their real estate businesses, if the properties are together, considered a trader business together, then there are no W-2 wages, but they do have some tangible property that they can take that into account, and so they will get some element of deduction for that in this year. So then the final test is against their taxable income. There is a final bumper there to test out, and they wind up with a $46,000 Section 199A deduction. But all of that looks relatively straightforward and simple, but it is not. There are still many questions, such as how this will apply to tiered entities. So if one entity has wages and passes income up to another partnership that does not have wages, what happens? Can you still pass those W-2 wages out to the ultimate owner? Or what if the one generating the business does not have wages, but the one receiving the upper tier does have W-2 wages? How do you define a trader business? That is an open question that we have. Can one rental property count as a trader business? Can we group activities together? What about activities that are both in and outside of the United States in one organization, one S corporation? Can those activities be split up to allow for one deduction there? What about activities that are say in a law practice or some other kind of business that has a portion that could be a specified trader business and excluded from the deduction, but another portion of the activities might qualify if we were to separate those businesses? What about leased employees? They are not W-2 employees of the trader business, but they do work for and are considered to be employees of that business, but their W-2s comes from a PEO. And how will we get all this information reported out to the partners and shareholders? I remind you, because we're standing on about a month away from the deadline for partnership returns at March 15th, and S Corporation returns at March 15th, that's going to mean a lot of additional information to be gathered and readied to go into those Schedule K-1s in preparation at this time next year. Each individual owner's situation will dictate whether or not they receive a benefit. The example I showed you showed a couple with income over $610,000. If their income was less than $300,000, there would have been no limitations, and they could have taken the maximum reduction. And the wife's business, her consulting business, we would have been allowed a deduction there as well. So they could have picked up even a better situation from their tax perspective. Corporate owners, they're not going to receive this Section 199A benefit. So a corporate owner and an individual owner will be taxed differently on the same kind of income coming to them. And finally, and probably one of the most important things to keep in mind, is Section 199A deduction, as with so many other provisions, is set to expire after 2025. So beginning in January 2026, the tax rates go back up. These provisions expire on this. So how aggressive or how much planning should we take into account between now and then, and how much do we weigh on the elements that some of this may continue on into the future? So with that is a lot to think about when it comes to Section 199A and the interest expense deduction limitations. Barry, now that C corporations are back in vogue, one of the things everybody keeps talking about is Section 1202, excluding gain from the sale of small business stock. Help us understand what that is all about.
Certainly, Sarah. So one of the things is 1202 is not a new provision. So this is not something that was brought in by the Tax Reform Act. However, because of the new rules on C Corps, it's now going to be a more of an opportunity for planning, and therefore may make the choice of a C Corp much more viable. So let's talk about that so that we have an understanding of how this works. So what is 1202? So when you have 1202 stock and you have gain from the sale of that stock, part of that gain is not taxed. So you have a 0% tax rate on that. The amount of the gain that is not taxed is the greater of $10 million or 10 times your adjusted basis. And we'll talk about that in a minute. So if I had a 0 basis in my stock and I had a gain of up to $10 million, I would pay no income tax on that at all. If I had basis of $2 million, that means I could exclude potentially up to $20 million of gain and have no tax on it. So you can see that in some respects this is a very powerful tool. So what do you need to do to qualify as 1202 stock? So there's two requirements. The first is the corporation, the entity itself, has to meet certain qualifications and be called a qualified small business, or a QSB. So what are those rules? One, it has to be a C Corp. So S Corps are out, so you have to be a C Corp. Second, it has to have assets of less than $50 million, both before and after any issuance of stock. And at least 80% of the assets have to be used in a qualified trade or business. Just as a side note, qualified trade or business, the specified services that they use in Section 199 Cap A that Sarah was talking about, they actually pull those definitions from 1202. So if you don't qualify for 199 Cap A, you will generally not qualify for 1202. The other thing that doesn't qualify is real estate. So you have to generally have an operating business to make this viable. So if the business qualifies, then the stock in the hands of the shareholder needs to be reviewed, and to make it qualified small business stock, QSBS. So how does a shareholder qualify his stock? First of all, you have to hold it for more than 5 years. So this is a long-term hold. If I hold it for 4 years and 360 days and sell it, it doesn't qualify. If I hold it for 5 years and a day, it qualifies. It is a hard cutoff. Second, I have to have received that stock directly from the corporation. So I could not have bought it from another shareholder. That doesn't qualify. The reason I acquired it from the corporation must have been in exchange for money, so I paid for the stock, or I contributed property or services. So if I get options and exercise those options, or if I'm granted stock in exchange for services, those those shares would qualify. And the stock must have been acquired after September 27th of 2010. Prior to that date, the exclusion is not 100%. After that date, it is, if you meet the rest of these requirements. So since we're talking about planning now, we're going to assume that we're talking about 100% exclusion. So let's talk about some other rules here. If the stock of the C Corp is held in a partnership or an S Corp, that stock can still qualify, and the shareholders or partners can still qualify, but there's some more complicated rules that have to be dealt with about what percentage of that stock may qualify. You have to basically be a partner or shareholder on the date the entity acquires that 1202, and then that is going to be the minimum percentage of stock that you'll be able to claim it on. It must be an active trade or business, which we talked about, excludes services and real estate. 80% of the assets must be used in the trade or business. If I liquidate a C Corp, so if I sell all the assets of a C Corp, that's not a sale of stock. But then generally I have to get the cash out of the C Corp. If I liquidate it under state law, so the C Corp no longer exists, that liquidation transaction is considered a sale or exchange of stock between the shareholders and the corporation, and that will qualify for 1202. There are a lot of technical rules involved in how you determine trade or business and the asset, and those rules must be met during substantially all the time period that you hold the stock. So during the full 5 years or more, you have to meet these rules. If you don't meet the rules, then it no longer qualifies as 1202 stock. So what's some of the pros and cons here? Well, obviously the pro is if you assume a $10 million gain at a 20% tax rate and maybe the net investment income, I can save almost $2 million of tax per individual investor. So the exclusion is based upon a shareholder. So if I get a $10 million exclusion and I own 25% and I've got 3 other shareholders who each own 25%, we can all exclude the $10 million. It's not overall, it's per individual investor. Obviously, it's very easy to understand. What are the cons? Is if I try to sell the assets out from inside the corporation, they're still going to have a 21% tax. Therefore, I'm not really getting an overall benefit because it would be as if I had capital gains and a pass-through. However, in certain circumstances where the income is going to be considered ordinary, then maybe this works because I pay one level of tax at 21% as opposed to one level of tax at 37%. The biggest con is it's a 5-year hold. It's an all or nothing provision. If I don't hold it to 5 years, I'm not going to qualify. It also means that some shares, if I acquire them at different times, have different holding periods. So it's actually based on the shares by share basis. So I could own some shares that would qualify for the exclusion and other shares that won't. And therefore, and the other problem becomes is if I do have a corporation and it has generated losses, when I sell those losses, that's going to be the buyer of those losses may be limited to the buyer. The other issue would be is any gain that's not excluded might be subject to a 28% rate plus the net investment income. We're looking into some issues surrounding that at the moment. So now that we've learned about the interest expense and the 199A and 1202, now we're going to put this all together because now comes time to decide what type of entity do I want to be. So as we talked about, the 199 Cap A and the 1202 gain exclusion are determined at the individual owner level. So what does that mean? It means I may have 2 partners or 2 shareholders that might have a different tax impact and might have a different desire for the entity that they're investing in because of their tax situation. So this just makes it a little bit more challenging. Again, we just talked about different owners being impacted differently, and the interest expense limitation carryover rules are different for each entity type. And remember, corporate owners do not benefit from 199 Cap A or 1202. So you have to look at who's your ownership group, especially in large partnerships or private equity. So let's talk about some of the factors that aren't really tax factors, but have some in play on choosing what type of entity I want to be from a federal tax perspective. Management functions, how is it going to be controlled? Sometimes that might have an impact. Income or loss outlook, is it going to generate losses and then income? Do the owners have the ability to take losses? So if I generate losses as a pass-through, I can save taxes now to my owners. If I'm inside a C Corp, I'm not saving any taxes, and that can only be used against any income the owner or the entity generates. Capital, am I going to fund this with debt or equity? Again, that may have an impact on the losses you're going to take, may have an impact on the interest expense limitation and any carryovers. Ownership, who are the owners? Different classes of owners or special allocations. Those may all lean you one way or the other as having an impact on the type of entity. And exit strategy. Frankly, this is probably is more important than even the annual potential savings is how am I going to get out of this entity? What's my exit? Am I going to sell the assets? Or am I going to sell the company? Am I going to have a public offering? Or am I going to have some type of transfer that's going to be exempt from tax? All of those considerations need to be taken into account. So what does that mean? Clearly, we've got a lot more items to consider, okay? More long-term planning. I can't just look at what's best this year, because once I lock into an entity, changing or getting out of certain entity types becomes comes at a tax cost. So you'll want to make that choice on a long-term basis, okay? Can I change? If I've got a current entity, can I change from where I am to what I think I want to be on a tax-free basis? And as we talked about briefly, there are some changes in accounting methods that might have an impact here as well. As we talked about different owners, different impacts, exit strategy has to be one of the considerations. So let's go through some factors and just talk about these for a moment. International operations. Clearly, as part of the Tax Reform Act here, a lot of the taxation of international operations has changed significantly with respect to C Corps, not as much as for pass-throughs. So now C corporations have the toll charge to bring back prior earnings, but future earnings can come back to the U.S. on a tax-free basis. So if that's the case, if I've got significant foreign earnings, maybe a C Corp works best. So there's a big difference now. So if you have actual international operations, and we're not talking about just sales of property overseas, we're talking about boots on the ground or foreign entities, international has to almost be your first decision point, is how is that going to have an impact, because that will probably be a significant driver in the entity selection. The second thing that's going to be important is, as we talked about earlier, is patents and other self-created assets. So now if I come up with a great idea and patent it, all of the expenses that I incur and things along those lines, and any gain is deductible, but any gain on the sale of that patent, which used to be a capital gain, which would be subject to the preferential 20% rate as an individual, is now going to be considered ordinary income. So for pass-throughs, that means a tax rate of potentially 37%, maybe 29.6%, depending on how those rules are written on the sales. Or inside the C Corp, if I sell it, it's taxed at 21%. So now, as we saw in one of the earlier slides, 37% versus maybe 39.8, and if I can make a play at the back end, like we talked about with 1202, where I don't have that second level of tax, maybe C corps make a difference here. So these 2 points are probably big decision points that may sway you more towards C corps than anything else. As we just talked about, would my C corp stock be eligible for 1202? Because again, if I can eliminate the back end tax on the distribution, then maybe it makes more sense because now I'm only paying a one level of tax, 21%. What's my exit strategy? Again, asset sale, stock sale. One of the things to consider is that as a buyer, they should not be willing to pay as much for equity as they would for assets. And the reason is if I buy company stock for $1 million, I'm not going to get any tax benefit. If I buy assets for $1 million, I'm generally going to get some type of depreciation or amortization off of that $1 million purchase price, and therefore that's going to save me tax over time. So generally the purchase price a buyer is willing to pay on a stock sale is going to be less than on an asset deal. Again, now if I've got a way to get out on a non-tax transfer, merger, death, or gift, maybe a C corp makes a little bit more sense. Again, who's going to be eligible for the pass-through deduction? Am I only going to have 1 or 2 shareholders eligible, or am I going to have a lot of my shareholders eligible? Again, that's going to have an impact, be a driver of my decision making. The other thing is, am I going to distribute earnings or am I going to retain them? If I'm going to distribute them, then the double level of tax immediately doesn't make as much sense because that cost is being incurred right now. If, however, I'm going to retain those earnings inside the business, well, maybe paying a little bit more later on makes sense if I can accumulate cash quicker because of the lower tax rate. But again, the key would be is how am I going to get that accumulated cash out? So if I still have to get it out at 39.8%, but if I was a pass-through that was eligible for 199 Cap A, it's only being taxed now at 29.6. Again, there's a decision point. Is that really worthwhile paying that extra amount of tax later on for that deferral? Again, those are things that you would have to work your way through. How's the entity selection going to be impacted by the interest expense limitation? As Mike talked about, every entity type is going to compute the limitation the same. The question becomes, what happens to the excess? So what's it going to do to my cash flow? Because now I'm paying out an expense that I'm not getting a tax deduction for currently. So my taxes are going to go up even though I don't have any more cash available because I'm losing a tax deduction. And then what happens with the carryover on an exit transaction? Is the current owner going to benefit for it, or is that something the new owner is going to benefit for? And if it is he going to be willing to pay for it? Maybe not. One of the other things we should talk about is, do I have related entities? Should they be combined? Should they be split? Again, if some activities qualify for 199 Cap A and some don't, can I split those? Again, we're going to have to wait for some more guidance on some of those rules to see what the determination that the service comes out with in some of their anti-abuse regulations. State taxes. As we talked about before, C corps get to deduct their state taxes, and individuals are going to lose some of that benefit. So you're going to have a higher tax cost at the individual level than inside the company. And as long as you're retaining cash in the business, that might have an impact. But ultimately, you're going to pay 2 levels of both federal and state. The other thing that's not considered very often, but should be, is how payroll is treated to the owners. With corporations, I'm subject to reasonable compensation. You've got payroll taxes. Some is paid by the corporation. Obviously, the withholding is paid by the individuals. And some of the benefit plans are available to owners in C Corps that they're not available in partnerships or S Corps. And in partnerships, if I'm an active participant, some of that income may be subject to SE tax, self-employment tax. S Corps are a little bit of a blend of both, so there may be things that can be done that way. So let's sum up some of our pros for a C Corp. Is international operations. Those are going to be things that are going to tend to want to maybe lean towards C Corp. Maybe if I've got patents or other self-created intangibles for ordinary income. If I retain the earnings over a long period of time. If I qualify for 1202 but don't qualify for 199 Cap A, and if I'm going to have a pro rata return to the owners, all of those things, again, are going to lean more toward the C Corp side than maybe the pass-through. That doesn't mean that you're going to go that way, but those are the type of circumstances where it's going to be more likely that a C Corp may result in a benefit. Again, one of the things you need to do is look long-term. You know, how well are you making these decisions? Because if I make a set of decisions based on a set of assumptions, what happens if those assumptions don't come to play? So one of the things you need to think about is how sensitive your assumptions are to changes, or how sensitive the results are to changes in your assumption. So cons against choosing a C Corp. Again, if I'm going to distribute in earnings currently, I've got a short hold period, meaning I'm not going to qualify for 1202. If I do get a benefit of 199 Cap A, that reduces my effective rate. I've got waterfall allocation, so what I've got is I've got returns to certain people that are going to be different from others, and if I want flexibility on an exit strategy. With C Corps, to get some of the benefits as a seller, I want to sell stock. If I've got a pass-through entity, I have more flexibility because of the capital gain treatment on those. So those are some of the cons for C Corps. So with all that being said, there's a lot of things to consider. So Sarah, you want to take it from here?
Yeah, absolutely. So yeah, how do you even begin to start thinking about this? And we've had to take that into account in advising our clients. And thinking about this, first is you have to build some sort of modeling approach to looking at, first, the rate analysis change. You know, what does it mean to be in a C corporation paying a 21% rate versus being in a pass-through situation and paying at a higher percentage rate? Do I get the benefit, or would my owners get the benefit of the 199A deductions? How am I going to be impacted by interest expense limitations? Stephen Covey had it right when he said in one of his 7 habits of highly effective people that you begin with the end in mind. Where am I taking this business? Where is it going to go? Because that weighs very heavily in our decision as to helping folks make a decision about what sort of entity to exist in. In addition, I think it was Warren Buffett who said after the recent tax law change, he was the one that said, hey, I just got an 80% raise in my companies because he's able in those C corporations to retain, he used to be able to retain 65% or 66% of the earnings after a 34-35% tax rate. Now he gets to retain 79% of the earnings after a mere 21% tax rate. So from his perspective, this is a terrific opportunity to boost the earnings of the company, and in a situation where they can be reinvested and grow within that framework without having to distribute more to pay taxes currently. That he sees as a win-win situation. All in, we think that everybody should take a look at their entity, even if there is no change or you don't anticipate a change. A look and a thoughtful analysis is always valuable. The other reason we want to bring this up now is that the check-the-box elections, that's the Form 8832, is an automatic way to change an entity type for certain situations effective as of the first day of the year. That has to be filed within 75 days of the start of the year. So if we want to make a change of entity type as of January 1 of 18 for a calendar year company, we have an opportunity to do that right now and take advantage of these rates from the very start of the year. That does not mean that is the only time you can make a change. You can certainly choose any different date to make an entity change. Maybe you have a transaction or an issue or something that needs to be resolved before you want to make an entity change, and that could then make a change as of July 1, make it a 6-month in the middle of the year change, or maybe your tax year doesn't begin until March 1st. So you have further into this calendar year to decide when to make that entity choice. But this is here. It is an option. It is strictly a federal tax election to change your entity type. It does not change anything about your legal organization, but it does have consequence to it. And we would certainly want you to be able to think through all of those actions and activities. So that is it for our discussion today about business entity modeling, about the choice of entity. You guys have asked some great questions. I think something that has come up and we touched on a little bit, but clearly you can see with the interest expense limitations, with the pass-through 199A, filling out the pass-through schedules K1 next year are going to be very complicated. More information is going to have to be provided to partners and shareholders, and all this new information will have to be incorporated into the individual tax returns of the partners and shareholders. And we're still not quite sure how all of this is going to happen in a tiered entity setting, and how well all of that information is going to flow up from Partnership 1 to Partnership 2 to Partnership 3 out to the owners and of Partnership 3. So something to bear in mind. The IRS is working very hard to think about the guidance they can issue this year, all of the changes they have to make to the tax forms. It's going to be a lot of moving parts, and we expect hopefully by late summer and fall we'll have some answers to some of the questions that you guys are asking, and that we just don't know yet because the definitions and guidance is just not finished yet. We have one more in our series of webinars. So next Tuesday, we'll be talking about how tax reform is going to impact state and local taxation, what that means to you.